Thanks for tuning in to today's podcast. Please remember that all of the information in this podcast episode is limited to general information only. That means the information is not specific to you, your needs, goals, or objectives, so you should seek the advice of a licensed and trusted financial professional before acting on the information. And before you acquire or apply for a financial product, please read the PDS or product disclosure statement, which should be available on the issuer's website. Lastly, please keep in mind that past performance is not indicative of future performance. In this episode of the Australian Investors Podcast, I chat with Jamie Nemtsas and Drew Meredith of Wattle Partners Financial Planning. We talk about risk profiling and using that to set your strategic asset allocation and tactical asset allocation, how you can tilt your portfolio, hedge your portfolio, and generally build a portfolio statement and construct and manage your portfolio throughout market cycles. This is a fascinating chat because we reflect on some of the moves that the guys made during COVID, and also as we think about rising inflation or potential rising inflation and rising rates. It's a fascinating conversation, and I'm sure the guys will be back to join me in the future. As always, I hope you enjoy this episode of the Australian Investors Podcast. Drew Meredith and Jamie Nemtsas from Wattle Partners, my partners in crime, for today's podcast episode. Thanks for joining me on the show. Drew, I know you've been unwell the last few days, mate, so I know you're making an extra effort this Friday morning. Thanks for joining me.
Thank you.
Yeah, and Jamie, second time on the podcast.
I know.
Drew and I have done a few, but you're looking good, mate. It's good to have you back.
I'm looking good because this is audio only, right?
Today's podcast, we're going to cover basically how you guys think about risk profiles and then how that feeds into building a portfolio or constructing a portfolio from the top down. So that strategic asset allocation, and then how you tilt portfolios, because I know we got some good examples to throw around, particularly coming out of COVID. And just in general, I guess, you guys have been doing this long enough. So lots of value to add. Drew, throw it over to you first, mate. Straight in the deep end. Can you just explain, I know a lot of our listeners are familiar with like what a risk profile is, but how do you go about determining a risk profile when you meet a client or when you just come across an investor?
Yeah, so I think it's probably one of the more complex parts of providing advice. You know, a lot of people assume you answer a few questions and that's your risk profile, but I think anyone that stops there, it's not enough. It's an evolving issue. We think really risk profiling is about finding out your tolerance to lose money, almost, for lack of a better way of thinking about it. Yeah, exactly. And I think like most things in finance, it's an imperfect science. So, you know, you start with we think we use what the best of breed risk profiling software that tries to take into account behavioral, issues and biases that we have. That's a platform called Finametrica, I think, Jamie. But for us, it's about understanding the objectives and also the person and their experiences over an extended period of time rather than just a once-off. Particularly, I mean, Jamie will probably explain that your risk profile changes in the middle of a crisis or in the middle of a bull market.
Correct. Yeah, trying to ascertain someone's real risk profile is incredibly hard, and it starts with, it's essentially about knowing them, knowing their situation, and knowing how they'll react. So the risk profile tool is a great way to start, but it depends on their level of capital, their level of knowledge, and most people in an up market are bullish, and most people in a down market are bearish. So we constantly reassess risk profiles for clients. There's also a need as well. We come across a lot of clients that have a need, that being an income need in retirement, and they have a limited. Everyone has a limited amount of capital. It doesn't matter who you are. You've got a certain amount of capital. Now, if those two objectives don't match, then typically what you would need to do is run a portfolio that's more aggressive. But that's the issue, right? If you run a more aggressive portfolio to achieve their objectives, but their risk profile is more conservative, what is the right answer? The right answer is spend less money, but most clients don't respond to that very well. So it's a constant and continual balance in terms of assessing clients' risks and attitude. And as Drew said, it changes, right?
And you have to, as an advisor, right? Like the risk kind of has to be the setting, right? In that instance, like where you've got competing priorities, because surely you can't. Well, I would think you can't really move them further up the risk curve for the sake of reaching those goals, or like what are some of the things that you would do or implement to kind of have that trade-off with clients, that discussion?
There's an important thing that we've gone through recently, which is having informed consent. So if you are suggesting someone needs to take more risk to achieve their objectives, they have to be completely understand the additional risk that they're taking on, what their potential losses are, rather than just suggesting something that don't challenge their objectives and just suggest something that's a high risk, because in theory it will give them a higher return.
So it's so easy to lose focus for investors. And when we talk investors, Drew and I talk investors, we typically talk to investors plus 50, and we typically deal with those clients until they pass away, right? So they typically have a pool of capital. We're not talking about accumulators right at the moment. And that's a majority of our client base. And the way that people see their portfolios, and most people see their portfolios, is just a number at the bottom. We write fantastic quarterly reports that go through, and we can talk about what it goes through, but they're 25 to 30 pages, and the last page has their total valuation of their portfolio. And most people flip to the last page and then they assess.
Yeah, read it back to front.
They assess, was it higher or lower than last quarter? And if it was higher, they put it away and don't read it. If it's lower, they probably call us up and go, well, what's going on? So
they question the one investment that's gone down as well.
So what you can do for clients that are a little bit more nervy is get them to focus on different things. And one of the things we've been doing for a long time now, Drew, is getting clients to, especially in retirement, is focus on what the portfolio might produce as income compared to what they need, and then focus on how many years of cash reserves do they need to hold to feel comfortable. So if they want $80,000 and the portfolio produces $60,000, there's a $20,000 shortfall. Say that's a $30,000 shortfall, and in a market downturn that might fall to a $40,000 hole. Then if we hold 5 years worth of that, do they feel comfortable? Or 10 years worth of that, do they feel more comfortable? And then get them to focus on different things rather than the last page of the report. And if you can say we're always holding, 5 to 7 years worth of cash or the cash gap, then typically they'll allow a more risky, they're happy to take a little bit more risk because they're focused on a different thing.
Do you find when clients come to you, because I normally deal with accumulators, right? And you guys deal with both. Do you find when clients come to you and they're, closing in on retirement or just in retirement, they've got these large balances, do you find they've thought that way? Do you think they put that cash aside knowing that this is going to cover me for X number of years, or is it really just kind of all over the place?
They tend to be more conservative than what even they think. So part of the risk profiling questionnaire we use asks them what they think their score would be on a scale of 0 to 100. And pretty much every single one, their result is more conservative than what they think it is.
Right.
And I think we've studied behavioural finance recently too, and I think loss aversion, which is what you're talking about, is that they're more afraid of losing money than they are of missing out on returns generally. So it's almost starts with a negative capital protection footing.
I mean, we're totally off track, but that's exactly right. Most clients come with a portfolio that is a lot more risky than their risk profile, but they don't perceive it to be that risky. And then they really don't know the performance of their portfolio over the last 7 years. So, they've had different pots of money come in, rollers of superannuation, inheritances, retirement benefits, and they can't tell you that they average a 5% return or a 7% return or a 4% return. So our job is to find where they're comfortable, that achieves their objectives, and educate them to the degree that they need education. So some people will come and they'll already get it, right? So totally understand that. Others don't. Sometimes that re-education has to happen in crises or when one partner dies, but it's essentially a process that we go through with each group. What's your risk profile? What's your tolerance to risk? Watch how they act in market downturns, and we're going to talk about market downturns later. That kind of anxiety builds if you don't do anything in a market downturn, and it evaporates if you actually do something, even if you're buying something. So
I think the industry has got too focused on the portfolio as the outcome. So you can see it major funds everywhere. You answer all these questions, you either end up in a conservative, balanced, or a growth option. But it's, as you can tell from the discussion, it's far more nuanced than fitting everyone into 2 or 3 buckets. It's more about, one, what returns do you need? If you've got $15 million and you only need 1% from term deposits, well, why would we tell you to put it into anything but term deposits? But not many people have 15 million, and term deposits at 1% isn't a lot either. So you got gradual risk taking from that point onwards, but it's important to match that up with what you're seeking. Otherwise, when volatility does come and you're more exposed than you probably should have been, that's when bad decisions or emotional decisions are made.
Speaking of like the interplay between risk profiles and SAA, or strategic asset allocation, I know you guys, because you guys have hundreds of clients, right? So you go about effectively building these buckets. Jamie, you and I talked yesterday about how you think about portfolio construction, taking the kind of the best of breed in each of the buckets, and then you kind of mix and match. Can you just give us like the overview of the SAA approach and how you think about those buckets?
Well, it's really important you have a framework in all this. So the framework that we're using is called strategic asset allocation. And essentially it's a process of splitting your investments into 2. So that would be what we call your growth assets, and the other would be your defensive assets. In defensive assets, we have 3 subcategories, that being cash, e.g. no market volatility, available all the time, or available within a week. And then you've got fixed income, which essentially provides exposure to the bond market, typically longer duration, and provides income. And the third category is something called defensive alternatives, which has got that non-market correlated risk, typically produces income, not a lot of volatility. So when we go through a risk profiling process, we'll determine how much in the defensive component of one's portfolio. And then we have growth assets, and our growth asset categories, and these slightly change depending on which advisors you use, but our categories is Australian shares, international shares, and then growth alternatives. So some advisors would have property at the bottom there, but we put them all in growth alternatives. So in each category, then we decide what investments go into each category. Each category has got a number beside it. So we might say, hey, your defensive assets are 30%, and that's broken up into 5% cash, if that's the right number for the client, and then 15% in fixed income, and defensive alts might be 10. And we use that as a guide of where a portfolio sits every time we review it, each quarter or each half year. And then anything that's outside, plus or negative, soft is kind of 2.5%, but 5%, we would automatically be rebalancing it back, or we would be recommending we balance it back. We also run a tactical asset allocation, which is kind of strategic, is more or less a 15 to 20 year view. Tactical asset allocation is if you had a 1 to 3 year view on something. So maybe at the moment, and I think this was on the agenda to talk about, if you're fundamentally worried about higher rates because of inflation, then you you wouldn't want too much in your fixed income component, which had long duration. So you might take 10% or of the allocation that was in fixed income and put it into your defensive alts where you don't have duration risk. So if you get higher rates, then you're not essentially going to lose capital. So you've got your SAA, then TAA.
So what would be defensive alts? It kind of sounds like this mysterious bucket to a lot of people that don't really know about it. What would be an example of a defensive alt in terms of product or in terms of, asset class? Just any example would help.
We're probably a bit more conservative. I know a lot of groups, maybe who knows who it is, they basically put anything that is mortgage-like. So, a term deposit is a form of debt to a bank. Yep. So anything that's similar to that, it could be property-backed debt, mortgage-backed debt, corporate, but loans to corporates. There's some different rating levels of different bonds as well. So a lot of people would put them just straight into the fixed interest bucket, but we think it's important to differentiate between, there are slightly different risk levels there. Yes, a perfect example would be corporate bonds.
So like Australian corporate bonds or international as well?
Yeah, primarily Australian, but really you can include anything in there that isn't a AAA rated government debt, basically.
Yeah, typically in that bucket they would be floating rate versus fixed rate. We would have things like gold and credit and absolute return funds, and generally the things that fit in there have to meet a kind of another framework, and that framework would be around volatility. So you want the volatility to be low, and you want the drawdown from top to bottom, e.g. the highest the value's been to what it could fall in a crash, to be kind of limited as well. We roughly maximum we'll ever go in investments is 10 and 10, at 10 being vol, that's monthly vol, and 10% from top to bottom. So typically they're a lot better than that, and typically they're providing some kind of yield to the defensive bucket.
Less correlated. So the key with the alternatives buckets is that they don't move the same way that the fixed income and the equity buckets do. So you think fixed income, it's usually full of government bonds that are fixed rate, long-term, 7, 10, 15-year government debt. So if interest rates rise, they'll perform poorly. This bucket is really talking about if interest rates rise, they won't be impacted, basically, if that makes sense.
Yeah, it does. How did that bucket for you guys react during COVID? Because I know, I don't know if my hybrids fit into this bucket as well, but there was a fair bit of volatility there that we saw during COVID. How did that kind of fare throughout?
Talk about this rebalance. So I think it feeds really well if we talk about rebalancing, right? So the concept of rebalancing is always really simply, when you rebalance, you say your equities have run really well, you're selling things at a profit, and typically you're recycling them into other categories that haven't done as well, right? So it's selling high and buying low, essentially what the rebalancing process is. And it's incredibly important to rebalance your portfolio, and there's lots of articles about rebalancing on a regular basis. 6 monthly seems enough. 12 monthly not quite enough, but to maximize risk-adjusted returns. The thing that Drew and I have learned over I'm 45, turning 46, so 25 years I've been doing this, is the rebalance is even more important, is the most important in a crisis. So most advisors would not go to their client when the client is fearing most and saying, this is awesome. We should sell all the assets that haven't fallen and buy all the assets that have fallen, which is fundamentally what rebalancing is, right? It's a nicer term, rebalancing. So rebalancing, and we did it in 2008, and we did it last March or April. The confidence to go and rebalance, where you just, you're selling things that haven't fallen and you're buying things that have fallen. So then I think that's we then can talk about what we did. And this is not just about Wattle Partners. We're a bit different because we kind of look at the world from a top-down perspective, but also a bottom-up. So those actions that we did in our portfolio, do you want to talk about them, Drew?
Yeah, I think in relating it back to the defensive alternatives question, we actually didn't have a lot in there at the time. I think there were one or two investments, and we were very much more so in the fixed interest and government bonds, given what the conditions look like. Central banks were reducing rates and implementing QE, and the result was similar to the defensive alternatives. There's this growth alternatives bucket that also has a preference to or a requirement that you don't lose money when markets fall. So what we did in about March, April, and July last year was identify that the equity component had fallen significantly. So if you looked at an asset allocation, it was clear. The alternatives had either stayed the same or gone up, and the bonds had generally gone up, fixed interest had generally gone up as well. So tactically sold portion of those assets. I think it was only about 5 to 10% of the portfolio, Jamie.
Yep.
And allocated it. So on the top level, took 5-10% from those, allocated it into global equities, domestic equities, and actually defensive alternatives, so credit, because all three of them sold off. Credit less so, but equity significantly, as everyone knows. It's no surprise there. We didn't do it because we thought markets were going to recover in 6 weeks or 8 weeks, like they did. It certainly helped, but we can go to the micro level as well.
So that's like top down, and then from a bottom up, we, in our preference share, that's essentially how we get a lot of the fixed income portion of our portfolio. Preference shares listed, we directly buy them. We saw there was a mispricing, what we thought was a mispricing of anything that had a long duration preference share was being valued down 10 or 15% from its par value, where the short
like a 5 or 6 year maturity.
Yeah, so 6 years to mature. They were trading at a big discount because there was lots of uncertainty. We had a lot of short-term preference shares, kind of that were maturing in the next 1 to kind of 2.5 years, and even that they traded down a little bit, not to the same degree as the longer duration preference shares. So we just simply switched them. Sold the short, bought the long. Now that's really unusual for a financial planner to get into that detail. The result was they all trade pretty much back at par or both post-par.
Above par now, yeah.
Yeah, so from a client's perspective, rather than a 2-year preference share going from $97 to 100, we've been able to sell at 97, buy something at 88 or 90, and it's gone back to 100. So that was a move. That was kind of a decision at the time, and we saw the opportunity. We also have a currency policy internally, and we've had this for a long period of time, and that just says that we hedge currency when it's two standard deviations from long-term mean, which basically means currency is about 73 cents is long-term mean. So if you're 2 standard deviations away, we hedge it up or we unhedge it. So currency dropped to 55.5 cents, and because it's not it's a policy, it's not a decision. We just said, okay, we've committed to this for the last 20 years. It works, so let's hedge everything up we could. So obviously added enormous value. So in terms of what we did, it wasn't a lot. It was 3 or 4 movements, but the value that created for clients is substantial.
How did you hedge? So how did you hedge? You just switch into the hedged products, or it's like hedge funds, hedged versions of funds, and whatever.
S&P 500 ETF switching from unhedged to hedged. Most managed funds that aren't, some are actively hedged. Obviously, you can't control those, but anything that had a hedged option, we basically just switched it in the middle of the. I think the dollar was at 60 cents or something.
What are the types of? And sorry, Jamie, you mentioned the types of preference shares. You mentioned preference shares that you bought directly before. What would be an example of the preference shares you're buying?
We typically only buy bank preference shares because
Right.
bank preference shares have got APRA looking at the capital adequacy of the underlying company. So if you buy a corporate preference share, they only have to announce to the ASX twice a year, and who
Right.
knows. So where it's constantly monitored if it's a bank. So we only hold bank preference shares. So in each bank, top four, and they essentially have a whole series of them. So you can pick your series and your maturity, and your
That'd be the
credit
most
rating. So,
clear arbitrage I think we'd ever seen.
but that's what happens in a crisis, right? When markets go to crisis, you have to somehow have a framework that you can go to clients and say, okay, this is a great time to rebalance, and then put a set of recommendations to them. If they saw it one by one, they mightn't do it. But this concept of rebalancing and crises really work. And I think that's we kind of there's a guy called Justin Pascoe that used to be the CIO of VFMC, and now he's a head of equities at Australian Super, and he's an incredibly smart guy. And I saw him present once, and he talked about never understanding the embedded call option that cash or non-market investments have. And the example would be if you had managed money for the last 20 years and you had it in cash for the 20 years apart from big market corrections, and you just bought the all odds, and you held it for 2 years and then put it back in cash, and you did the same, put it back in the cash. So over the 20 years, you would only have your money exposed to equities for 2 times, and for 4 years out of the 20, and you picked up the cash rate for the whole period, your portfolio return would be substantial. It would be probably better than any other pension fund around over that period of time, and you've only held market exposure. So understanding that cash does more than just produce a little bit of income. All these things that we hold, defensive alts and fixed income, hold a different role in the portfolio, and the role is really this embedded call option to buy cheap stuff. And that extends to when you get crisis like last year, where you see every corporate ASX listed company raise capital. Now, they seem to raise capital at the most ridiculous times, and they raise it at substantial discounts. Now, when that happens, if you're an active investor, you want to be able to have cash to buy all these things that go on sale. And we're not talking about small companies. We're not talking about micro companies. We're talking about ASX 50, ASX 100 leaders. All the banks raise capital at pretty close to the bottom. So if you don't have cash or things you can sell and buy these opportunities, you miss out on a great opportunity to maximize your long-term returns.
For us, we start with, we call it an investment policy or an investment policy statement that kind of has driven every pension fund, every family office, every, maybe not hedge funds, but every successful investor. Basically, it has a framework to help make decisions. So when we speak with clients, we build that for them as the first kind of discussion point, and you're negotiating the key points about it. It talks about amount of positions in your portfolio, the policy on hedging, even things like your responsible investment views or your ethical preferences, and then it guides the decisions that happen on a quarterly basis or in crises. So, you're not just sitting there making it up in the middle of a crisis. You're prepared and you have a strategy to deal with it.
And then you go back to amend it, right? If you're not sure, if something's gone wrong, go back and amend your investment strategy. It only has to be, half a dozen pages, if that. But, it's just a constant learning of how to be a better investor is this main document called IPS, investor policy.
Every investor, pretty much every person we meet lacks that structure or even having any strategy at all. Every portfolio, probably a lot of advisors, every portfolio looks pretty similar. All a mix of popular things, but no actual structure. Why did you add this? Why have you got a random credit strategy? There's no overall strategy involved.
Yeah, it's a really interesting thing. I can't imagine, Like we tend to write down our rules for investing, like as a stock picker or equities focused guy. We have these vast checklists and rules and filters, whatever, to buy shares and to focus on quality and blah blah blah. But then coming back, like relating that back to the personal finance strategy overall, I don't know many investors that actually adopt like an investment policy statement, write that down, and have these rules written in advance. And there's some clear, like there's a clear value prop there, right? Like you just mentioned, having those rules in advance is most important. And Jamie, to your point about like that embedded call option in cash, that's something that took me a while to kind of wrap my head around as an investor because you just see interest rates falling, right? And you think of opportunity cost, and you think, "Geez, this sucks." But that's fascinating, right? I guess the key there is one of the questions people might have is, well, you guys made these great calls during COVID, and then you cited that the other investor who brought up the study over 20 years. Timing matters, right? Like, how do you determine? You've got two standard deviations for FX to go hedge or unhedge. How do you decide when you would take that cash off the sidelines? Like, are there predetermined rules that you guys use for that? Is there a framework for that?
We at the moment, so we believe in quarterly rebalancing. So we do quarterly reviews, and then in crisis. So as soon as you see those allocations breaking, so if you've said 30% in Aussie shares and it's down to 22.5 or 21, then it's a good indicator. You're not going to get timing 100% right ever, but you can definitely put things in place that helps your return.
Timing's
timing last in March and April, and timing's that horrible word, but it's really just being tactical. It worked because as soon as we didn't even get all the money in, markets took off, right? In 2007, 2008, that wasn't the case. I think we rebalanced and it went down further, and that's harder. You rebalance and then markets go down another 20%, and you go, I thought 4,500 was pretty good for the all odds, and it's down at 3.2. Yeah, and that's where patience and comes into it. Investing, and probably as advisors, we're one step back than we used to be. We used to be really, really active, would know when share prices went up and down and, every announcement on the market. And we're probably one back from that now. Well, I am definitely. And I think that has made me a better advisor, because you're going, well, what's the opportunity set here in this market, and what looks hot, and where should I allocate money versus, NAB's down 42 cents. I wonder what's happening there. Are they going to cut their dividend? In a portfolio context, the bigger top-down moves typically add a lot more value than a little bit in this and a little bit in that for most investors.
And I think a lot of the academic literature backs it up, right? But the portfolio management, the SAA is, as an explanatory factor, is so much more powerful than the security selection, right?
It's more about being exposed and staying exposed. So we saw last year, if you sold anything, you capitalize losses and you never recovered. So SAA is basically a tool to make sure you don't sell when crises happen, or you're not selling your growth component, because the power is from the SAA, but making sure you're always exposed to the asset classes that are growing.
Mm. Mm.
I think a lot of so when you do talk about portfolio build, there's a lot of and these are our peers, but there's a lot of unsophisticated approaches to portfolio build, and that's typically when you get say when we allocate our international share allocation, we have two managers up the top that manage the large cap exposure globally. They're both active, so we're a house that believes in active investing, adding value, and they have both done that. And then we have a mid cap. We go to mid cap manager, a small cap manager, and then we have a tilt to Asia. And then if you looked at the overlap of stocks that you're owning, it's very, very minor. And if you look at the 5 or so portfolio managers, they definitely have different mindsets and they approach it from a different perspective.
So
that's how we do it.
That means meeting the fund managers and actually understanding what they do, right?
Sure. Yeah, if you don't know, like we get paid a decent fee to provide advice to our clients. So we take the role on of understanding that fund manager as closely and precisely as possible. Sure, we get all the research right, but that doesn't really help us. That's outsourcing the obligation that we have, which is a fiduciary obligation to the client to know the investments. So we want to know the portfolio manager. We want to know what they're doing. We want to talk to them. We would use, say, a Morningstar Direct to make sure all their holdings, there's no overlap. And a lot of exposure last year, and we've seen portfolios and they're exposed to three fund managers, and they're all done phenomenally well. But if you pulled off the lid, they're all exposed to Tesla, and they're all overweight to Tesla, and they're all 10 to 12% of Tesla, and they all did fantastically well. But that's not really, you just needed one of them, right? Did you really need just to have one and buy 3 times the amount? There's no point in spreading your investment and saying, hey, I'm diversified over managers and I've got 3 different managers and they're all growthy, they're all buying the same stocks just in different portions. And we see that, honestly, we see it 80% of the time when portfolios come in. They go, oh, we're really happy with these. What's the point? And a lot of times you can go and buy the S&P 500 index fund for 10 bips and you're doing the same thing. So
that naive diversification is the word, isn't it? Similar to someone will come in and say, I got all 4 banks. That means I'm well diversified across the banking sector.
Yeah, market risk, specific risk, all that fun stuff. Gents, I feel like this is a really good primer on portfolio construction, just covering off like the absolute essentials. Maybe you guys can come back next month and we can talk more specifics around maybe different funds. Something that we could talk about is like rising rates, how you use that defensive alts bucket, some of the manager questions and interviews you do with them, because I know you guys are meeting them like every day. I feel like every day I walk in the office, Jamie's in an interview with a manager, Drew's writing something about it, a manager too. So I think this is a really good primer. So if people want to find out more about you guys, head to the Wattle Partners website, right?
Yeah, for sure.
Exactly.
Yeah, go there and give us a call. We're always, as you can see, we both chat all day, every day. So the easiest way is just give us a call and we're happy to have a chat. Sure.
Some good videos and podcasts on there we can plug, I think.
Yeah, there are too. Yeah, I'll put links in the show notes to the podcast you guys are doing, interviewing fundies as well. So occasionally you guys go live as well, which I'm told is, I have it on good authority, is a spectacle.
The word spectacle's right. Yeah, it's definitely a spectacle.
No, great. All right, Jamie Nemtsas and Drew Meredith from Wattle Partners. Thanks for taking the time out to join me on the show today.
Thank you.